Interest rates are at a 14-year high. Is now really the time to be remortgaging your property? Stay to the end of this video, by the way. I'm going to be showing you the way to get the cheapest and best deals through your remortgage. But first of all, what is a remortgage? What does it actually mean? Refinancing, remortgaging. Essentially, usually when people say remortgage, they mean get a new loan on their property by a mortgage provider. So for example, let's say scenario one might be I've purchased a property for 100,000 cash. I've then done it up and I want to get a mortgage on it to pull out my equity. So the idea is the lender or the bank or provider will give me usually about 75% of the value of the house. Money goes in my bank. I pay them an interest rate and then I can do with the money what I want. Now, some people go, you can't use it to buy more property. There are some providers that stipulate that, but in large, it's bullshit. You can definitely use it to buy more property. So let's jump straight in. Should we remortgage now? Well, let me go through some scenarios because there's really only one that I would consider, but I also want you to understand it's really not that bad. So first of all, if you have got a property with a mortgage on that is in fixed interest, there's no equity, so the value hasn't gone up too much, let's just say, based on your loan, and you're in a fixed mortgage term where the interest rates are low, then no. Why would you suddenly remortgage and pay more money when the rates are higher than maybe 2 years ago or 5 years ago? For example, I've got a 5-year fixed on my house, paying £1,200. It's going to come up in January or February. I'm going to be paying about £2,000 a month, all right, over that actually. I'm not in a rush to make that happen, all right? But let's look at why you might consider it, and then let me tell you some stuff around inflation and utilizing it. So where would you look at this? Well, first of all, if you're at the end of your mortgage term, you really don't have a choice, and you're definitely going to have to stick around for this video because I'm going to show you how to get access to the cheapest deals available. But you might actually have another year on your mortgage and go, well, why would I refinance now? Well, if you're looking to invest in property, which I imagine that's why you're on this YouTube channel, but maybe not. Maybe you're just here to understand a bit more about how interesting that works. But let's say I've got 100,000 in equity that I would be able to release by getting a mortgage on it. Now, some people would go, no, why would you do it? It's a 14-year high. It's like, yes, but actually the long-term interest rate average since, I want to say 1846, but it might be slightly off by a few years there, is 5.9%. So actually, we are below average. As of today, you can get mortgages at 5.44% relatively easily on 2-year fixed, okay, with very low fees. So with that in mind, it's actually below the long-term average. But what you want to be thinking about is, what would you do with the money? And this is a key thing. People go, oh, no, don't refinance. It's a terrible idea to get mortgages right now. Or, no, it's absolutely fine. It's like, well, first of all, I'm going to tell you why it's fine in a second. But actually, the truth is, what do you intend to do with the money? For example, when I'm investing in a boring vanilla buy-to-let property, the minimum returns that I'm really looking at is going to be a total return of 12% or more on an annual basis. Well, think about this logically. If I can invest my money at a minimum total return of 12%, is that 12% higher or lower than what I'm going to be paying a mortgage company? A mortgage. Obviously, it's higher. Therefore, that is a good decision for me. If you're able to invest your money at the same, then obviously it's a good decision. Please don't take any of this as financial advice, by the way. However, if you're thinking, hey, I can get hold of 50 grand, what should I do? Oh, we could go on a holiday. I wanted to buy a new car and all of that. Well, I'm never really going to condone that because I just don't believe in buying liabilities. I believe in purchasing assets that pay for my liabilities. So that's when to use it and definitely take advantage of that. And I would not be scared about the interest rate whatsoever. And there's no way of saying this with humility, but like I've got over £1 million in my bank account net that's just sat there, and I will still purchase with mortgages. I will still refinance and leverage my properties. And you get poor people all the time going, if you had £1 million in your bank account, then why would you do it? Because that's how you become a millionaire. How do you become a decamillionaire? By taking on millions of debt. Unless you've got a business that's pumping out money. Grant Cardone, how has he got a $4 billion real estate empire? By taking on around $3.2 billion of debt. What a shock. All right, that's how you get wealthy. Now, here's why I wouldn't worry too much, and then I'll go through how you can get access to some great deals. So the reason I wouldn't worry too much is because of inflation being higher. Now, what is inflation? Well, the first thing to understand is there's true inflation, which, by the way, is still around double figures. And then there's the advertised inflation. It's changing all the time, so there's no point in even me saying it in this video, because by the time you watch it, it might be out. But look on the government website for inflation that you're told. And then you can Google true inflation, and it will show you the adjusted returns and things like that. Inflation is the erosion of the value of money. So it doesn't mean that money goes out of your bank account. It means that everything else gets more expensive. So, for example, you might remember Pringles when you opened a box of Pringles or a what would you call it? Tin of Pringles? We'll go a tub of Pringles. We'll go with tub of Pringles, open it up, and it used to be full to the brim and it was £1 or whatever. Now it's a couple of quid and it's 50% air, right? That's inflation. In housing terms, let's say you've got £100,000 and you could buy something, X over here, let's say this widget, a house, for example, for £100,000. Let's say inflation is 10%. It doesn't mean that your money is now only 90,000. What it means is, all things being equal, that house will now cost you 110,000. So money in your bank, bad, very bad. Money in a leverageable asset, good. And the reason for this is you are getting money at lower than inflation. I think this is so hard for most people to understand, but if the interest rate that you are getting charged on a property is lower than inflation, in real terms, the debt that you are taking on is eroding in real value faster than the cost of the debt, which means, in very simple terms, you are getting paid to have debt. Now, it's not literally that, obviously, but that's the most simple way of explaining it. But you need to make sure that you can afford the monthly cost. But what are they? The two key things you are going to have is your broker fees and the interest rates and your prop fee built in, okay? So what are these? Well, obviously you're going to have broker fees. A decent mortgage broker is going to cost you £500 up front as a fee, and then they're going to take a small fee in the back end. What you really need to be careful of right now is the amount of fees that mortgage products are adding to the lend, okay? Now, what I would be doing is I would pay slightly more on an interest rate with 3% fees by the mortgage lender, rather than getting a lower interest rate by maybe 0.5% but paying 5% fees. 5% fees are fairly hefty, but that's what a lot of lenders are doing right now. Now, there is a way to not only get the best rates and not pay an upfront mortgage broker fee, and that is using today's video sponsor, Lendlord. I've been using Lendlord for a couple of years now. I've used them for lends, I've used them for bridging, I've used them for analyzing deals. You can get access and utilize these to get access to the best lending available. Now, their panel is quite wide. What that means is that access to finance is really strong, and you don't pay them anything apart from if you utilize these products, they're going to get a back-end fee. And honestly, they're absolutely brilliant. And for me, it saved me tens of thousands of pounds personally. So I'm not just saying, hey, these guys are good, you should use them. I have used them multiple times. I am going all in on them. I want to be a part of them long term, right? And they're really truly adding value. It's the one-stop shop for everything property. You'll see when you go on there, by the way, you get access to so much more. But I strongly recommend using the link below, because you'll get some discounts on lends and you'll get access to premium features as well for free. I just want to summarize this up. I am not by any means saying get debt, get debt, get debt. But I think we grew up all the time. I certainly did. Debt is bad. Never get loans. Never get credit cards. The dream is to pay off your mortgage. And as I've become more financially successful, or whether I'm successful overall is a different question, right? But financially successful, I've realized that debt is your friend, not your enemy, if it's used for the right reasons. And honestly, like, would I be a millionaire now without debt? Probably. Like, I probably would be. I want to be honest with you there. However, getting debt in the right places has definitely accelerated my journey. And I'm not sat here going, I'm worth hundreds of millions, because I'm not. But I am a multi-millionaire net worth. But what I am saying is get on Lendlord and talk to somebody that is qualified to give financial advice, because I'm not, by the way, and I want to be really clear there. But honestly, you'll realize that debt is your friend if it's used as an instrument in the right way. So if there's one takeaway, I would say there's such thing as good debt and bad debt. And what makes it good debt is what you're going to use the money for. Now, for me, I only take on debt for one of three reasons. Number one is my education. Number two is my marketing. And number three is investing in my assets. And you're here investing your time into education, and maybe now you can invest it in your assets. So click the link below. Let me know what you think of it, by the way. I absolutely love Lendlord. They're also really open to feedback. So if you're using it and you're thinking, hey, this could improve it, let me know in the comments. I'll send it back to Lendlord, and they're really adaptive and reactive to taking on that feedback. If you're new to the channel, by the way, you want to find out more about property in general, investing, bettering yourself, and looking forward to your financial future, then make sure to hit the subscribe and the notification bell. And if you did get any value from this video, it helps me out immensely if you just tap that like button and watch this next video.